If you're looking to benefit from market exposure in your investment portfolio, but fear the potential risks associated with direct investment in stocks or mutual funds, then structured notes may be a good option for you. Principal Protected Notes, or PPNs, are investment solutions that effectively combine the protection and income potential of bonds along with the growth potential of equities. Principal Protected Notes provide investors with full protection of principal if held to maturity, with an increased return potential relative to traditional fixed-rate products, as the potential return is based on the performance of the underlying asset, such as equities or an equity index. There are a number of potential benefits and potential risks associated with Principal Protected Notes, so it's good to understand them before making an investment decision. PPNs offer, hence the name Principal Protection if the note is held to maturity, exposure to the upside potential of the underlying asset without the downside exposure when held to maturity, exposure to underlying reference assets which may not be otherwise directly accessible, potential to receive periodic interest payments throughout the term, or a potential return payable at maturity linked to the performance of an underlying asset. It's important to note that they are different from traditional fixed income products, as they may not earn any return if the underlying asset performs poorly during the term, and they are not eligible for CDIC coverage. Selling a PPN prior to maturity may result in a loss of principal. PPNs may also contain terms that cap your potential return at maturity or offer a participation rate that is less than 100%. It's always important to read the terms and conditions of any PPN you're interested in purchasing to make sure you understand all of the features. It should also be noted that the Principal Protected Notes provide no direct currency exposure if the underlying reference asset is denominated in a foreign currency. In addition, there is the potential to sell the note prior to maturity through a daily secondary market. There are multiple types of PPNs with exposure to different underlying reference assets with a variety of payout structures that may help you to meet your short and long-term goals. An important consideration is whether you require periodic interest payments during the term of your investment, or are you focused on long-term growth potential, or even a combination of the two. When trying to determine which type of PPN might be right for you, you need to ask yourself whether you are looking for cash flow from your investment during the term, or don't require cash flow and would rather invest in a growth product that offers higher return potential at the end of the term. As mentioned, Principal Protected Notes track the performance of the underlying asset, and these different assets fluctuate in value over the duration of the investment. And the return is based on the change in value over the term of the investment and the structural features of the PPN you choose. Let's walk through an example of how this works. As a hypothetical example, you purchase a 2-year product linked to the performance of an equity index, like a Canadian blue chip index. This product has variable interest that will be paid at maturity and will be equal to 100% of the performance of the index. There are several options and lots of great information available. CIBC Structured Notes. Increase your return potential, not your risk.